Imagine two coworkers leaving the same office on the same Friday afternoon. They're both 30 years old. They both live in Denver. They both earn $85,000 a year before taxes. They both have $25,000 ready to invest. And they both commit to putting another $600 into the market every single month. Their financial future starts from exactly the same place. But then they make one decision that quietly sends their money down two completely different paths. Ryan decides he wants income today. He builds a portfolio filled with high-quality dividend stocks, paying attractive yields. Every quarter, cash lands in his account. He can see it. He can spend it. It feels like his money is finally working for him. Ethan chooses a simple, low-cost S&P 500 index fund. No exciting dividend notifications. No hand-picked companies. Just one boring investment that quietly owns hundreds of America's largest businesses. Both of them think they made the smarter choice. They're both missing something. Because 20 years later, one of them ends up dramatically wealthier than the other. Not because one investment was good and the other was bad, but because almost nobody runs the complete math. They compare dividend yield. They compare stock prices. They compare headlines. But the biggest numbers are hiding underneath the surface. And once you see them, you'll never look at dividend investing the same way again. To keep this completely fair, Ryan and Ethan begin with identical conditions. Same salary, same age, same city, same starting investment, same monthly contribution. The only thing that's different is where the money goes. Feelings are equal. The math isn't.
Ryan spends his weekend researching individual companies.
He settles on a diversified basket of large dividend-paying businesses. Utilities, consumer staples, healthcare giants, banks. His portfolio starts with an average dividend yield of about 4%. The companies increase their dividends over time, averaging roughly 4% annual dividend growth, while their stock prices appreciate around 5% annually. That creates a total expected return near 9% before taxes and fees. Ethan doesn't study earnings reports or dividend announcements. He simply buys a broad market index fund tracking the S&P 500 with an expense ratio around 0.03%. Historically, the S&P 500 has returned roughly 10% annually over long periods, although no future returns are guaranteed. Those returns come from both price appreciation and dividends, with dividends making up roughly 2% to 5% of the yield in recent years. Ryan smiles every 3 months when dividend payments arrive. Ethan usually forgets he even owns his investment. One feels rewarding, the other feels invisible. Feelings and math are two very different things. Let's fast forward 1 year. Ryan invested his initial $25,000 plus 12 monthly contributions totaling another $7,200. His dividend portfolio generated approximately $1,300 in dividends during the year. Assuming he reinvested every payment, his portfolio finishes around $35,900 before taxes. Sounds great, until you subtract everything else. Because qualified dividends aren't always tax-free. Depending on income and account type, qualified dividends may be taxed at federal rates of 0%, 15%, or 20%, with some investors also paying the net investment income tax. If Ryan holds these investments in a taxable brokerage account and falls into the 15% qualified dividend bracket, roughly $195 disappears to federal taxes. His after-tax value becomes approximately $35,700. Ethan also invested $32,200 total during the year. His index fund grows to approximately $36,100. Notice something interesting. Ethan actually received dividends too. Most people forget this. The companies inside an S&P 500 index fund still pay dividends. Those dividends are automatically reinvested inside the fund unless the investor chooses otherwise. So this isn't really dividends versus no dividends. It's concentrated dividend investing versus owning the entire market. That distinction matters more than most people realize. By year 3, Ryan's portfolio has grown to approximately $61,900 after reinvesting dividends and continuing monthly investments. His annual dividend income has climbed close to $2,500. Every quarter feels like getting a small raise. Friends ask him how much passive income he's earning. Nobody asks Ethan that question. His index fund has quietly reached about $64,700. He hasn't posted screenshots online. He hasn't celebrated quarterly payments. He simply owns more businesses than Ryan does. Ryan begins telling people his portfolio pays him. Ethan's portfolio simply compounds. There's a subtle psychological trap hiding here. Humans love visible rewards. A dividend payment feels like winning. A rising share price feels abstract because you don't actually see cash arrive. Behavioral economists call this mental accounting. People often treat dividends as income, even though economically they're simply one part of a company's total return. When a company pays a dividend, cash leaves the business and goes to shareholders. The company's value generally falls by roughly the same amount on the ex-dividend date. The money didn't appear out of nowhere. It simply changed pockets. By year 5, the gap begins widening. Ryan has contributed another $36,000 over 5 years, bringing total contributions to $61,000 including his initial investment. His dividend portfolio grows to roughly $96,800 before taxes. His annual dividend income now approaches $3,900. That sounds impressive. It is impressive, until you subtract everything else. Ryan has likely paid federal taxes on thousands of dollars in dividends over those 5 years if the investments sit inside a taxable account. Assuming cumulative qualified dividends of roughly $13,000 and a 15% tax rate, nearly $2,000 has quietly gone to taxes, not because he sold anything, simply because the dividends were distributed. Meanwhile, Ethan's index fund reaches approximately $102,900. He also received dividends. But because broad market funds typically produce lower dividend yields, a larger share of his total return stayed invested through price appreciation, allowing taxes to be deferred until shares are actually sold in taxable accounts. Deferred taxes can become an invisible advantage. Money that isn't immediately paid to the government continues compounding. And compounding doesn't just work on investments. It works on taxes you haven't paid yet. This is where many investors accidentally compare the wrong numbers. Ryan looks at his $3,900 annual dividend income. Ethan looks at his total account balance. They're measuring different things. Imagine owning a bakery. Would you rather the bakery pay you almost every dollar it earns each month, leaving less cash to expand? Or would you rather it reinvest more profits into opening additional locations that increase the bakery's overall value? Neither answer is automatically right, but they're different strategies producing different outcomes. This is exactly why some of the world's most valuable companies pay little or no dividends. They believe they can earn a higher return by reinvesting capital back into the business. Other mature companies have fewer high-return growth opportunities, so they return excess cash to shareholders through dividends. Neither approach is inherently superior. The important question isn't whether dividends are good. The important question is what happens after the dividend is paid. Now here's the part almost nobody talks about. Ask someone why they love dividend investing, and you'll usually hear one number. My portfolio yields 4%. Yeah, that's the headline. But headlines rarely tell the whole story. The first hidden layer is taxes. A 4% dividend yield isn't necessarily a 4% spendable yield. Depending on account type and tax bracket, federal taxes alone may reduce that income by hundreds or even thousands of dollars every year. State income taxes can reduce it even further. The second hidden layer is slower retained growth. When companies distribute billions of dollars to shareholders, that's capital they aren't using for acquisitions, expansion, research, or stock buybacks. Mature companies often make that trade intentionally, but it still affects long-term growth potential. The third hidden layer is concentration risk. Ryan owns about 35 carefully selected dividend companies. Ethan owns roughly 500 of America's largest public companies through a single index fund. If one of Ryan's holdings cuts its dividend, his income drops immediately. Ethan usually doesn't even notice when one company stumbles because hundreds of others continue working in the background. And that's only the beginning of the story. Over the next 15 years, the compounding becomes far more dramatic. The hidden costs become easier to see, and one simple change of just a couple $100s per month ends up rewriting the entire ending. The next 5 years are where the story quietly changes. Not overnight, not with a market crash, Not because one investor suddenly became smarter. It changes because compounding starts rewarding tiny advantages that look meaningless in the beginning. By year 10, Ryan has now invested for an entire decade. Including his original $25,000 and monthly contributions of $600, he's personally contributed $97,000. His dividend portfolio, assuming an average 9% annual total return with dividends fully reinvested, has grown to approximately $194,000 before taxes. His annual dividend income has reached roughly $7,800. That's more than $650 every month. If you only looked at that number, you'd think Ryan was clearly winning. After all, he now has an investment paying him almost enough to cover a car payment every single month. On paper, that's $7,800 a year. Sounds great until you subtract everything else. Over 10 years, Ryan has likely received nearly $38,000 in cumulative dividends. If those investments are held in a taxable brokerage account and taxed at a 15% qualified dividend rate, approximately $5,700 has already gone to federal taxes alone. Depending on where he lives, state taxes could easily add another few hundred to a couple $1,000s. None of those taxes showed up as a dramatic bill. They quietly chipped away at compounding every single year. Meanwhile, Ethan has also contributed exactly $97,000. His index fund has quietly grown to approximately $214,000. No flashy income screenshots, no quarterly celebrations, just a larger pile of assets. That's about a $20,000 lead. Not because Ethan picked better stocks, not because Ryan made a mistake, because a slightly higher total return, a lower expense ratio, broader diversification, and greater tax deferral compounded together. Small edges become big differences when you give them enough time. Now fast forward another decade, year 20. Ryan is 50 years old. Ethan is 50 years old. They've both remained disciplined, neither panicked during bear markets, neither tried to time the market, neither skipped their monthly investments. Ryan has contributed a total of $169,000. His dividend portfolio has grown to roughly $610,000 before taxes. His annual dividend income is now close to $24,000. That's real money. For many families, that's enough to cover groceries, utilities, or even a significant portion of annual living expenses. Ryan finally feels like his investments are paying him a salary. But Ethan's story is different. His index fund has grown to approximately $760,000. That's roughly $150,000 more wealth. And remember, the index fund also paid dividends along the way. They were simply a smaller percentage of the overall return. The larger driver was long-term business growth across hundreds of companies. Now imagine multiplying that difference over another 20 years. Or imagine retiring with that additional $150,000 still compounding. The gap doesn't stay $150,000 forever. It keeps growing. This is where most online debates completely fall apart. People argue about dividend yield. Very few people compare after-tax total wealth. Those are not the same conversation. What nobody talks about is that every investment has layers underneath the headline number. Let's pull those layers apart. The first is dividend taxes. If your investments sit inside a taxable brokerage account, qualified dividends may be taxed every single year. In contrast, much of an index fund's return comes from unrealized appreciation, allowing many investors to delay capital gains taxes until they choose to sell. That timing difference matters. Money left invested keeps earning returns. The second layer is expense ratios. Many dividend-focused ETFs charge between roughly 0.06% and 0.35% annually. Broad market index funds can charge as little as 0.03%. That difference sounds tiny, but on a $700,000 portfolio, paying an additional 0.20% means about $1,400 every single year. Again, tiny percentages, big dollars. The third layer is concentration. A dividend strategy often leans heavily towards sectors like utilities, energy, banks, telecommunications, and consumer staples. Those sectors can perform well for long periods. They can also underperform when faster-growing industries lead the market. An S&P 500 index automatically adjusts as the economy changes. 20 years ago, technology wasn't nearly as dominant as it is today. The index adapted. Individual investors have to make those decisions themselves. The fourth layer is dividend cuts. People often assume dividend stocks always pay reliable income. Usually they do, but not always. During recessions, companies sometimes reduce or eliminate dividends to preserve cash. The share price often falls at the same time. Now you've lost both income and value. The fifth layer is behavioral risk. Ironically, this one favors Ryan. Receiving regular dividend income makes many investors less likely to panic during market crashes. They see cash continuing to arrive even when prices fall. Some investors find that psychologically easier than watching an index fund decline without receiving much visible income. Behavior matters. A strategy you can stick with usually beats a perfect strategy you abandon halfway through. Now, if I only showed you the downsides of dividend investing, I'd be doing exactly what many investing influencers do. Reality is more balanced than that. Dividend investing has genuine strengths. If you're retired and need reliable cash flow, selling shares every month may be less appealing than collecting dividend income. If you're someone who struggles to stay invested during market crashes, dividends can provide emotional stability that keeps you from making expensive mistakes. Some dividend companies also have decades-long histories of increasing payouts year after year. That consistency can be valuable. On the other hand, index investing isn't perfect either. You don't control which companies you own. If the overall market falls 35%, your portfolio falls too. There's no downside protection built into simply buying the index. You'll also own companies you may personally dislike. The index doesn't ask for your opinion. It simply follows the market. There are also situations where dividend investing can genuinely outperform. If high-growth stocks experience a long period of weak performance while value stocks lead the market, dividend-focused portfolios may outperform broad indexes. If you're investing entirely inside tax-advantaged accounts, like certain retirement plans where current dividend taxes don't apply, one of the biggest disadvantages becomes much smaller. And if you build a diversified dividend portfolio at attractive valuations during periods of unusually high yields, your long-term income growth can exceed expectations. Context always matters. That's why the answer isn't always buy dividend stocks. The answer also isn't always buy index funds. The answer is understanding what you're actually optimizing for: income, growth, taxes, behavior, or some combination of all four. This is also where one small change completely reshapes the outcome. Let's go back to Ethan. Suppose instead of investing $600 every month, he invested $800. Just another $200. That's $2,400 more each year. Over 20 years, he personally contributes only $48,000 extra. But because of compounding, his portfolio doesn't grow by just $48,000. It grows by roughly another $170,000 to $190,000, depending on market returns. That's the power of increasing contributions, instead of endlessly chasing a higher yield. One decision changes the ending more than finding the perfect investment. This isn't just theory. According to the S&P Dow Jones Indices SPIVA scorecards, the majority of actively managed U.S. equity funds have historically underperformed their benchmark indexes over long periods after fees. That's one reason low-cost index investing remains a popular long-term strategy among many investors. Morningstar has also consistently shown that expense ratios are among the strongest predictors of future fund performance. Lower-cost funds, on average, have historically outperformed higher-cost peers because investors keep more of their returns. And the Internal Revenue Service continues to publish the federal tax rates applicable to qualified dividends and long-term capital gains, which are generally 0%, 15%, or 20%, depending on taxable income, with additional rules and exceptions that may apply. Those aren't opinions. They're simply published facts. So what's the practical playbook? First, decide your objective before choosing your investment. If your goal is maximum long-term wealth, compare total return after taxes and fees, not just dividend yield. Second, use the right account. If you're building a dividend portfolio, consider whether holding it inside a tax-advantaged retirement account makes more sense than a taxable brokerage account, depending on your circumstances and local tax rules. Third, Increase your savings rate before chasing investment complexity. An extra $200 invested every month often creates a larger long-term difference than switching between similar investment strategies. Simple, concrete, actionable. Now let's come back to Ryan and Ethan. They both walked away thinking they made the smart play. Ryan believed the visible dividend checks proved his strategy was superior. Ethan believed buying one boring index fund meant he never had to think about investing again. Neither of them actually ran the full numbers. Ryan underestimated the long-term impact of taxes, diversification, and total return. Ethan underestimated the value that dependable cash flow can provide for investors who prioritize income or who need psychological reassurance during volatile markets. The real trap isn't dividend stocks. The real trap isn't index funds. The real trap is making the decision based on hype, headlines, or someone else's opinion instead of running the numbers for your own situation. Because your goals matter, your taxes matter, your timeline matters, and the strategy that's perfect for someone else may be completely wrong for you. If you're wondering what happens when someone combines both strategies, using broad market index funds for growth while building a dividend income stream alongside them, that's a completely different conversation. So before you make your next investment decision, ask yourself one question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.